Right. Well, J.P. Morgan CEO Jamie Dimon predicting trouble in the bond market. Dimon speaking today with CNBC's Morgan Brennan at the Reagan National Defense Forum.
You are going to see a crack in the bond market, okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine. We'll probably make more money, and then some of my friends will tell me that we like crises because it's good for J.P. Morgan Chase. Not really.
Classic Jamie. For more, let's bring in CNBC contributor David Zervos. He's Jefferies chief market strategist. David, great to have you with us. Do you think that we will see that crack in the bond market? I feel like you're a not panicking kind of guy, but should we be concerned about that?
Yeah, you've had me on a number of times recently, Melissa, trying to not get people to panic about tariffs, and tariffs seem to be consistently moving in a non-panicky way after the initial panic. And I think the same story in the bond market for me, and the whole idea that we're going to have a Liz Truss moment or some sort of backup in yields because everybody's scared of holding U.S. Treasuries. I don't buy it. I think you can tell stories where the term premium's a little bit higher. And I like that story. We've steepened the curve a lot this year, and that makes sense to me. But the idea that we have some major crack does not seem like a reasonable story to me.
David, I was sitting, hey, it's Tim. I was sitting next to you on the desk, and I remember your calm. And I think, I guess the question I have for you is, where is your fear moment here for this market? And again, there still can be calm, but what is the thing that worries you most here, especially as you think about strategically a market that has come back and roared back to where we were?
Yeah, it's funny, Tim. I remember your comment because I went on a little diatribe, and you go, "Wow, that felt pretty good."
Yeah,
and I think we were in the middle of the second week of April, and that was what I was trying to do with a lot of our clients, talk them off the ledge, even some of the most sophisticated. And it was a complicated time. There's not a lot that really makes me nervous in terms of policy and in terms of geopolitics. I'm always nervous because I think those events are not anything we can ascribe easy probabilities to, but they're there. There's wars going on. There's potentials for changes like what we had in COVID era. There's always those, but I do feel like we have a lot of insurance. We have a central bank that's got rates over 4%. If something goes horribly wrong, we have a lot of insurance and monetary policy that I think could be applied quickly and judiciously, even if the politics might initially get in the way of that. And so my worries are probably pretty low, consistent with where they've been for a while.
It's Karen. Thanks for being on. You generally look like a guy who's not super worried about a lot. But let me just ask you, what do you think about the Fed? Do they need to do anything? If you were Jay Powell, what would you be doing?
Well, Karen, I'm not a big fan of saying what I think the Fed should do. I'm like, that doesn't make my clients any money because I'm not in control. So I try to predict what I think they will do. I think they're going to be a little sticky. I think they've been a little sticky. I thought Jay was going to play ball with the president a little more friendly pre-April 2nd. And I think he, like many others, saw April 2nd and went, oh, my God, I can't have a red jersey on. This is crazy stuff. And he backed away. And the markets really saw that in the second week of April when the Fed didn't respond to all the madness in the bond markets. And ultimately, I think the Treasury Secretary is the one who stepped in and stopped it. But I will say, if you push me, Karen, and you say, what do you think you should be doing? And I think there is a CNBC group that I'm part of that we put our what we would do if we were in the FOMC or on the FOMC. I would be cutting. I'd be cutting pretty significantly. I don't think there's a great storyline here to have rates 200 basis points above neutral. And I think neutral is still somewhere in the low to mid twos. We've got inflation all the way back. We had another great PCE report. And there just doesn't seem to be a great story for that. I think you're playing with fire and you don't need to.
David, that's where I was going to go with PCE and CPI. It does seem like mission accomplished, right? So why not just take the victory and take the lap and move on? Is it obviously the dual mandate is what's getting in the way here, but I think they've done enough to check the box.
I think the fact that he got rid of QT early, he did that in the end of Q1, that seemed like a nod to the new administration, like he was going to play ball with them. And then I said tariffs just got the Fed twisted up with, typical DC politics where they just don't want to be seen as enabling behavior that people consider to be reckless, whether that's true or not. I don't believe it. I think it was just negotiating tactics, but I understand where others come from. I guess where I would come out on the debate for what they're going to do is I think Jay's got 1 year left. He wants to go down in the history books as the guy who combated the great inflation without a lot of job loss, and that's a good story for him to spin. There'll be people that say he started the inflation, but I think that's a harder sell because every G7 country had the same amount of inflation. So I think he's going to be a little more stubborn, and that'll be slowly coming out of the bond market because forward guidance will lose Jay and it'll move to whoever the new candidate is. And we might learn about that new candidate within the next 3 to 6 months. As Secretary Besson has said, they're interviewing for the new Fed spots probably by the summer and certainly the fall. So we're going to hear from, whether it's, there's lots of horse trading on these. Is it Kevin Hassett? Is it Kevin Warsh? Is it others who have been in the mix before? I think we're going to start to hear a different forward guidance that really isn't Jay Powell anymore.
David, last time you were here, you said that the markets were massively overplaying tariffs, which was, in hindsight, the right call. So have the markets have processed in sort of the volatility surrounding tariff headlines. Has the market also processed the economic impact of the tariffs, which have yet to really manifest themselves in the hard data? And I'm assuming that there will be some impact in the hard data, unless you think that there will be no impact in the hard data.
So, Melissa, great question, and let's decompose it into the two parts that you asked. The first part is, how were we thinking about this? I came from the camp of this is a tactical art of the deal, classic Trump-style negotiation where he's going to go big, be a little crazy, try to dislodge the opponents, and get them to accept something that actually would have been hard to get without going crazy at first. And I think many people did not see it that way. Many people thought this was some sort of actual true ask in terms of the starting point from negotiation. And it just didn't fit the typical pattern of what we've seen with this president before. So I think if you step back and said, okay, this is all tactics, this is to try to drive a fair trade outcome, to get people to come to the table, to get them to reduce their tariffs, their non-tariff barriers, maybe strengthen their currencies like the Taiwanese have done almost 10% since negotiations have started. And the dollar itself has weakened significantly on a trade-weighted basis. All of that was part of the rebalancing story. And I think that's largely played out, and the market's more accepting of the view that I had. Whether there's an economic fallout, the second part of your question, Melissa, is a harder question. And it just depends on where we land. There could be a really positive impact because people just say, okay, we're done. No tariffs. We're out. We don't want it. We're going to let you sell cars and sell beef and sell soy. Come on in. We just want to make sure we have the U.S. markets open for business. We're scared we're going to lose that. Done. And we're going to strengthen our currency a little bit so we aren't playing games with competitive devaluations and unlevel playing fields. And all of a sudden, it's actually a bigger pie that we're all sharing for global economic growth. And that's one story. And the other story is, you get a little inflation, you get a little stagnation, you get a little, because the tariffs stick around during that negotiation process longer than we would hope for.